Hello, everyone. I hope you had a wonderful, long, relaxing, warm weekend. Got a little bit of snow here in Ohio, which was nice to see. At least that's my opinion. I always feel that if it's going to be cold anyway, there might as well be snow. Just better to look at, better to play in and have fun in. But anyway, so I apologize for anybody out there who hates who hates snow. But welcome to 2021. This is our market outlook for the year. Obviously not going to be doing a live event this year due to the COVID pandemic. Want to keep everybody safe. But before we get started with the outlook, just again, as always, want to let you know that this presentation is being recorded today, Monday, January 18th, Martin Luther King Day, in the evening. But all data, all charts, everything's based on the market closing prices as of Friday, January 15th, so this past Friday. Obviously, market prices are subject to change, and no opinions stated herein constitute a prediction or guarantee of any future results, of course. So with that all being said, let's go ahead and look at the agenda today. I don't think anybody's upset at all about slamming the door in the face of 2020 and moving on to a new year. Obviously, 2020 was a crazy year, and I'm very much looking forward to 2021. And hopefully this pandemic I don't want to say going away, but as the vaccines roll out, maybe getting back to somewhat of an old normal, if you will. So we're going to talk about 2020, kind of what happened this past year briefly. Then we're going to go over the current state of the bond market, interest rates, talk a little bit about relative strength, building a winning portfolio strategy, sticking with what I call the playoff teams and what that means. We'll go over, I know this is probably going to be the third or fourth time in a video or podcast that I've gone over our new strategic, or what I call static model portfolios, but we're going to go over those briefly. And then lastly, we'll finish up and wrap up today with a stock market update for 2021 and outlook, and then kind of some post-election year seasonality statistics and expectations for this post-election year that we're living in now. So let's go ahead and move ahead. Let's start right away with slamming the door on 2020, which again, like I said earlier, was an absolutely insane year for the stock market. Unprecedented, record-breaking, pick the word, phrase. Some of these words like unprecedented, I feel like we shouldn't be allowed to use them in 2021 because we used them so much in 2020. But last year, the market went down faster than it ever has in U.S. history by a long shot. Black Monday was almost twice as slow as this crash was when you consider the top to bottom movement. So from the very top in 1987 to the very bottom of the market in that crash. Fourth quarter of 2018 was pretty fast, I believe at around 59 days, but that's obviously about three times as slow as the 22-day crash that we saw this past year. And of course, in 2018, the market only went down 19.9%, not 34% in only 22 days. And then to find the next fastest drop or bear market, you have to go back to the Great Depression, which I believe was over 100 days from top to bottom when you looked at that, call it third or fourth fastest crash in U.S. history. So 2020 was a really, really crazy fast crash, and of course right in the middle of this crash we start the pandemic lockdown. Businesses shut down around the world for at least 8 weeks, some places longer. And what I wanted to do was, speaking of 2018, I took earlier this year and I overlaid this little box, which again represents 22 days in the market, and I wanted to take that same time period and overlay it on top of the prior market crashes or prior drops or swift drops in the market that we've seen this past couple decades. And as you can see here, this same 22-day period, if you overlay it on top of the 2018 fourth quarter drop of 19.9%, you can see it happened. The 22 days only makes up about a third or so of that decline, understanding that the decline was only, again, 19.9% as compared to the drop that we saw in 2020, which was, again, almost 35% and three times the speed, so incredibly fast. You go back to the bear market in 2007, 2008, 2009, it gets even more ridiculous. And you can see here the same 22 days only makes up a very, very small portion here from October, the peak, and just 22 days go by, and that would have been, if 2007 would have been 2020, then we would have been done with the crash in only that 22-day period right there. But instead what we saw in 2007, 8, and 9 was a market crash that took place over the course of 18 total months, or in other words, 17 months later, after that first 22 days, the market was down a total of just under 58%. But it was a grinding crash, which is usually how these things work. And then if we go back further to 2000, 2001, 2002, the dot-com crash, this is what 22 days looks like back then. Similar, I don't want to say the same, but similar, we'll call it, to the 2007, 8, and 9 crash, where you've got this 22-day period that's very, very fast, right? Again, last year the market went down 35% almost in 22 days, and back in 2000, 2001, 2002, it went down 47%, but it was over the course of 2 years, 24 months. So after this 22-day period, we saw a decline that took place over the next 23 months before we finally hit bottom. And then the market's just acting funny. I mean, you look at this here, irrational exuberance, maybe. I guess we'll see. It's going to take time before everything plays out. But this is a tweet that I put out actually this past week about Tesla, rising to the point where it's the 5th largest company on the S&P 500, all while Tesla delivered 499,500 vehicles in 2020, only 2% of the total U.S. automotive market. So when to have Tesla doing as well as it is, and have Elon Musk be the richest guy in the world now, owning a company that only makes up 2% of the U.S. automotive market, just doesn't make a whole lot of sense. So take from that what you will. As I said in the tweet here, this data was from my friend Andrew Thrasher, who put together some other really interesting information. So I don't know. I mean, everybody wants a story. In my opinion, the story with Tesla is you've got a lot of excited buyers who are just really, really excited about Tesla and keep bidding the price up. I don't know that it's really worth what it's trading at today. But it's not my job to come up with a story, and the market doesn't really care what I think. So if something's going up and we get a good entry price, then we might want to own it because we might want to make money on it, even if it doesn't really make a whole lot of sense. So not everything makes sense. And speaking of things that don't make sense, here is the U.S. debt clock. And if you have never seen this, can be found by going to usdebtclock.org. And it's just a bunch of different numbers, everything from the total U.S. national debt to my favorite right here in the middle is the total percent or U.S. federal debt to GDP ratio. So right now, our debt represents 130% of what we produce each year, which would be equivalent to, say, a family that makes $100,000 a year having a $130,000 credit card. The hope is, of course, that interest rates stay really, really low because so that family can continue to pay low interest rates on that credit card and maybe pay down the principal very, very slowly. Because that's what we're seeing in our country right now is very, very low interest rates. We are seeing the Federal Reserve expanding their balance sheet. And, of course, we're seeing a ton of stimulus. And that's not going to stop, I don't think, anytime soon. Just last week on Thursday, we had Biden come out with his new stimulus package, which is going to be just under $2 trillion. So expect us to continue to see this going up. And I don't know when this is going to come to a head and when we're going to have to deal with this problem because we've been talking about it for almost 2 decades now. So maybe, I don't know, maybe we've got a long way to go before it becomes a problem. I'm not really sure. But I think that if there's one thing that is for sure, that it definitely is a problem. So we'll just keep an eye on that continually for the next several months and really several years as things move along here through this new 4-year election cycle. Speaking of interest rates, we were talking about rates earlier, the Fed funds rate. This is different. We're just talking about bond rates, I'm sorry. So how might rates affect bonds here? Obviously, when interest rates go up, bond values go down. And when interest rates go down, bond values go up. So as we've seen interest rates going down pretty much for the last 35 years, then bonds have done very well. Well, this past few years, the market's been telling us, or when I say the market, the bond market, the interest rate market, has been telling us that it's kind of going through what might be a bottoming process. And when that happens, you kind of get some choppiness, and it becomes very difficult to make money in bonds like the old days, where you just saw bonds are safe. All you got to do is put my money in bonds. I'll invest my money in bonds, and it's just going to go up real slow and safe. And when the market crashes, my bonds will do well. And that's just not the case anymore. I think we have to be really careful with our bond portfolios, because long term, as interest rates go up, we're going to have to look at other things or other investments specific within the bond market to help us protect our money first and foremost, but to make money. So right now, some of the best bonds or types of fixed income investments to own are things like convertible bonds that convert to stock. Actually shorting bonds, the 20-year Treasury, as rates have gone up, shorting the U.S. Treasury, 20-year Treasuries, for instance, is a way to kind of buy rates, if you will. It's not exactly the same. They're not literally buying interest rates, but you're basically shorting bonds. So if bonds go down in value, then obviously you make money. Just like if you were to invest in rates and they went up, then you would make money. Inflation protected bonds, so fixed income instruments, easy for me to say, that go up when inflation goes up. As we see commodities rise, we could see inflation going up here in the not too distant future. And if that happens, then things like WIP, the World Inflation Protected Bonds, or TIP, Treasury Inflation Protected Bonds, which is down here in this the fifth decile technically, so kind of in the middle. But you can see here, this is just a relative strength ranking that I use at my office. And you can see your 20-year Treasuries are up here, senior loans, high-yield corporate debt, so stuff like that. So this all rotates. Whenever we see the bond market move, we see this rotation where you see rotation out of strength, and bonds that did well yesterday aren't doing so well today. And I don't mean that literally. It takes days, weeks for these trends to change and for these cycles to take place. So as we start seeing different bond positions or different fixed income investments fall out of favor, we want to invest and keep our money invested in the investments that are in favor. And if nothing's in favor, if the best thing to own is just short-term treasuries and money markets and things of that nature, then that's what we need to do. That's where we need to have our money. Let me briefly go over our new portfolio models. Speaking of relative strength, all of our portfolio models are invested under the principles of relative strength, which just simply means staying invested with the playoff teams. So we can invest in everything we can invest in the world can be put into these categories: U.S. stocks, international stocks, bonds or fixed income investments, commodities, and currencies. So within the U.S. stock market, we might say, well, retail is a good sector, one of the stronger sectors, and within that sector, maybe building and construction is one of the better industry groups. And then from there, we can drill down and say, well, maybe Lowe's is one of the better companies within the building and construction industry group, within the retail sector, within the asset class of U.S. stocks, being a leader, let's just say. With international stocks, it's a little bit different because we're not talking sectors and subsectors. We're talking countries and regions. So we might say, Europe, Australasia, and the Far East is maybe one of the better regions. Within that region, Japan is one of the better countries. And then we could drill down and say Honda is one of the best stocks in the country of Japan, which is one of the better countries within the region, IFTA region, which is one of the better regions within the international stock landscape. And then with bonds, it's a little bit different because we're not talking, again, countries or even sectors. It's kind of like categories and subcategories. So we can buy corporate bonds, we can buy municipal bonds, we can buy treasury bonds, treasury inflation protected securities, we can buy senior debt. So there's all kinds of different types of bonds we can own. We can also invest in bonds based on maturity and duration. So we can invest in short-term, intermediate-term, or long-term bonds, or high quality or low quality. And now you might think low quality, that sounds horrible. Well, lower quality bonds based on rating is what's called high yield, because when you get a lower rating or a lower quality mix of bonds, then you deserve a higher interest rate. So you tend to get a higher interest rate on those bonds. With commodities, it's even more different, because we have, energy commodities, things like natural gas, gasoline, oil. We have precious metals, which, obviously gold, silver, palladium, platinum, nickel. With soft commodities and grains, agriculturals, things like cotton, soybeans, corn, wheat, things of that nature. And then those things any of those investments could become a leader at some point, which, they're not currently, but they could at some point. And then you have currencies, which obviously we can invest anywhere in the world in terms of currencies, whether that be someplace overseas or even the US dollar. So what we're trying to do here is we're trying to stay invested in, again, what I call the playoff teams. In other words, we don't just want to invest all of our money into a bunch of everything. So if I know the NFL playoffs are going on right now, so I'll use that as an analogy. If the 32 teams in the NFL are the only investments we can buy or we can invest our money in, we wouldn't want to just put in an equal amount into each team, because we know there's teams like the New York Jets and the Cincinnati Bengals that just aren't doing that well and haven't been doing that well for very long. But a perfect example of a team that maybe we wouldn't have touched for the last 17 years would have been the Cleveland Browns. If that were an investment, you wouldn't want to touch it, because why would you want to invest your money in an investment that's just been doing so poorly for so long? But then all of a sudden last season and this season you start to see some strength. They make the playoffs, and now you've got a team or an investment per se that we might want to put some of our money into at that point. And then we might want to avoid some of these other teams that maybe used to be in the playoffs every year, but they're just not anymore. Teams like, let's just say, the New England Patriots that didn't make the playoffs this year for the first time in a very long time. I think 11 years or something like that. But anyway, I digress. Julius de Campanaer came up with this brilliant idea on how to visualize relative strength and how to prove that relative strength exists. In other words, that rotation exists from improving to leading to weakening to lagging the market over time using something called a relative rotation graph. And you can see here, this is a 52-week cycle that I've put together. It's a little old, a few weeks old here. So what you see here is that as the COVID crash took place in early 2020, everything starts sucking wind, but then you have gold miners that are doing well, uranium stocks, online retail, IPOs, social media, lithium stocks, battery stocks, automotive stocks, small cap discretionaries. So things rotate, generally speaking, in a clockwise fashion, where the S&P 500, or the benchmark, is at the 0 point right in the middle here, and all these other investments are either weakening versus the market, bottom right, lagging versus the market in the bottom left, improving in the upper left, or leading the market and beating the market in the upper right. And again, the statistics say about 68% of the time, and I'm undershooting this, by the way, you tend to see this clockwise rotation, which again proves that this strength exists and it does make sense to invest in the playoff teams and avoid the rest. So with that all being said, these new portfolio models that I built are all static. So here are the old models that we're continuing to use. We haven't abandoned them by any stretch of the imagination. All of our models that we've been using for well over a decade at this point are tactical trend following models, where we could be aggressively invested or 100% in cash if that were necessary. We could be a conservative investor, or we could be 100% in cash. The point here is with tactical trend following models, using technical analysis as the basis for managing this money, all of these four models here could go into 100% cash, with the goal being to avoid catastrophic, life-changing market crashes. After the last year's COVID crash, again, happening so unbelievably fast, while I did increase the speed of the indicators and trends that I'm using within those trend following models by about 2.5 times the speed, there just wasn't a data set, obviously, that existed prior to 2020. In other words, there was no time in history to test over that where the market fell 35% in 22 days. So therefore, anytime something happens for the first time ever, you have to then include that information in your data when figuring out how to best manage the trend following model in this case. So what I did was I sped up our trend following indicators, again, by about 2 to 2.5 times the speed of what I was doing before. But I also felt it necessary because the market is moving so fast, and the speed at which market trends are moving has been accelerating so much that it made sense to create a second set of models, also aggressive, moderate, balanced, and conservative, but what we call static models or strategic models. And the way these models work is the allocation, or the target allocation, is the same as with the tactical models. So in other words, if we're in a conservative model, we still want to be invested at 40% stocks, say 35% stocks-ish, to 60-65% bonds, fixed income, cash, money market. Where, a moderate growth portfolio, we might want to be invested at, say, our target is 70% stocks, it's 30% bonds, cash, money markets, or so on, and they stay that way. So they do not, the way that these risk models work is they're not trying to get out of the market, which means that they're going to weather the storm, so to speak. So probably the best analogy is that the trend following models are trying to go into the bunker when tornado sirens go off and we start to see severe weather. They just go to cash, so we sell investments and try to avoid the market crash. Whereas the strategic static models do not try to get out of the market. They stay invested all the time, and they're basically trying to weather the storm and hope that they don't get hit too hard. So to compare and contrast these two sets of models, the tactical models, just try to think tactical is trend following, starts with a T, and the strategic models, S is, strategic starts with an S, so does static, so think static stays in the market. Both of them implement the asset class and sector rotation and industry group rotation, so both of them stay with the playoff teams. So in terms of what we're investing our money in, they both stay the same. They both do well in a sustained positive uptrend. Where they differ is, again, the trend following models manage risk by selling stocks, selling baskets of stocks, selling bonds, and getting out of the market when the market gets unhealthy, whereas the strategic models manage risk by the static model allocation. So, for instance, conservatives, say 40-60 stocks, bonds, aggressives 100% stocks. Now, what might happen is during a market crash, we might not own technology and biotech and online retail and semiconductors. We might instead, during a market crash, we might own utilities, high dividend payers, blue chips, and things of that nature, but we're still going to own stocks. The other big difference is that trend following models can be really, really frustrating during short, quick markets like last year, whereas strategic models can be really, really frustrating during long bear markets like 2007, 8, 9, 2000, 2001, 2002. The average market crash is about 16 to 18 months. The average crash is 42%. A strategic model is going to struggle in that kind of environment, whereas tactical models are going to do very well. But when the market goes down 35% in 22 days, tactical models are going to struggle. It's going to be very hard to avoid a market that goes down that quickly, because there's just no way to predict the future, and there's no way to know that it's going to be over that fast until it's over. So the point here is there's no such thing as an investment strategy that works all the time. They'll work over time, but not all the time. And again, where strategic models struggle, tactical models do really, really well. And where tactical models struggle, strategic models do really, really well. So as far as who this might make sense for, tactical and trend following models can make sense for anybody. It just depends on your personality, your investment objectives, how savvy you are with the markets, how acceptable you feel it is to take losses in the short term. Some people don't like taking big losses and would rather be out of the market wishing they were in than in the market wishing they were out. So it can make sense for anyone. Strategic models tend to make more sense for people who are either younger, who have a lot of runway in front of them, who have a lot of time on their side. You don't want to. Well, in my opinion, it's pretty tough to be invested at 100% in strategic static models when you're, say, 60 years of age and getting ready to retire in the next few years. Heaven forbid a market crash hits. You're in a moderate growth portfolio, a static portfolio, and you take the brunt of that crash on and lose, say, 40% of your money right before you're getting ready to retire. That would obviously not be a pretty picture. So I think that it just kind of which type of model, it just depends on the investor. And many times I think that it makes sense to use both and to have something that's working all the time. So I'll shut up about the models. I think I've talked enough about them today anyhow. If you have any questions, obviously, please feel free to reach out to me. I'm happy to go over them with you. But let's talk about the stock market right now and then going into next year. First and foremost, this is one of the many new indicators that I'm using. This is just a simple 50-day moving average. You could also look at a 10-week moving average in blue, the blue shaded areas, and I like to call this underwater. So I always love analogies. I just think it helps make everything make more sense. And when I'm looking at this, nothing good happens underwater. Now you can dip your head underwater right here, like in September or November of this past year for a little while. We were underwater in September for 1, 2, 3, 4, 5, 6, 7, 8 days. It looks like maybe 9. And you can spend a little bit of time underwater and come right back up for air. Here in October, November, we got 1, 2, 3, 4, 5, 6 days underwater, and that was it. So if we're just underwater for a short period of time, then no big deal. Where it starts to become a problem is if you're underwater for a long time, or if you're going deeper underwater, that could be even a bigger problem. Then what ends up happening is your portfolio drowns. So right now what I'm seeing is the market's going up. I see an uptrend. I see an uptrend from an intermediate term standpoint, an uptrend from a long-term standpoint, and I actually would not be surprised with as much as this thing's been charging northward. I would not be surprised at all to see a pullback in the not too distant future, but I would also see that pullback as an opportunity to buy, not a reason to panic and freak out just yet. As long as the Fed is printing money, expanding their balance sheet, and as long as the government is pushing stimulus like crazy, I think it's pretty hard to fight that. So I don't think there's anything to panic about right now, I guess is what I'm saying. Furthermore, this is Lowry Research. Lowry I've subscribed to, and they've got some great metrics when it comes to what's called buying power and selling pressure. This just kind of splits up the up days and the down days in the market. What we always want to see is we want to see big up days, and with small down days, that indicates an uptrend. And of course, we want to see small down days because that indicates low selling pressure. So what you can see here is ever since pretty much June, like just end of May, beginning of June, buying power took over selling pressure. Now both were trending down. When buying power is trending down, that's a problem only if selling pressure is trending up. In this case, it was a decline in buying power and selling pressure. But right here at about September-ish, we started to see this expansion or a change in trend from down to sideways. And then officially in November, we started to see this divergence away where buying power started increasing while selling pressure started decreasing. So this tells me that, again, it's more supportive evidence that on an intermediate term basis that the market's in pretty good shape, regardless of the fact the economy looks absolutely horrible. But we'll just have to see what happens. So for now, things look good, though. Moving on. So I talked earlier about the playoff teams, staying invested in the playoff teams. And right now at this moment, if you're wondering who those playoff teams might be, for a while now, solar stocks have been one of the playoff teams. In fact, I would call them the number 1 seed in the playoffs for quite a while here. And when I say quite a while, going back to probably June, July-ish. You could even argue that solar stocks almost predicted the election because, obviously with a Biden presidency, clean energy is probably something that will do well. In the number 3 spot here, number 2 is just a double leveraged Russell 2000 ETF. I wouldn't recommend anybody buy that on their own. But the number 3 is, cannabis ETF. So marijuana stocks. I don't have to repeat myself here and why that might be making sense right now. But this is more of a recent emerger. It wasn't until November that we started to see cannabis start to come into play. Lithium stocks, lithium battery stocks for things like electric vehicles, Panasonic, companies like that. Genomics, I'll go fast through these. Blockchain, robotics, momentum stocks, steel. So think infrastructure here. So if we're going to have investment in bridges and roads, and revitalizing neighborhoods in Seattle, perhaps, then steel and other infrastructure-based investments might make a lot of sense. Online retail is still up there and doing very well. We're starting to see banking come back into play. So we're starting to see, as interest rates have gone up, we've started to see financials doing well. IPOs have kind of drifted down here a little bit in the past few weeks, but IPOs still look good. Who would have thought, by the way, that 2020 would have been a great year for an IPO market? It's just insane. But anyway, I digress. Metals and mining, global auto, so automotive stocks. So these are all kind of what are in the playoffs right now in this top 2 deciles in my inventory. And as long as we're staying invested in those playoff teams and walking away from or selling those investments as they drift away in strength, then we're going to be in a pretty good shape during an uptrend in the market, as long as the market's rising. And then from a seasonality standpoint, we've got The S&P 500 here in a post-election year, you tend to see muted returns, and the reason for that is kind of a joke, I guess. Maybe it's true. I don't know. That in post-election years, politicians don't really care anymore, and there's really no need to try and get reelected. So you tend to not see such a big drive northward in the stock market because politicians aren't trying to do anything to make the market go up or prop it up. Because really, everything with the election behind us. Now it's on to other things. So the post-election year tends to be a pretty muted year on average for the market. And you can see that when you compare that to all other years going back 59 years here in this example, market return about 8% per year, whereas the average return of a post-election year is more around the 4% range. So does that mean we should expect 4% returns in the S&P this year? I have no idea. My goal, or my job, I should say, is to stay invested in the strongest investments, in the strongest asset classes, in the strongest industry groups and sectors, and to rotate out of those investments when they start to weaken, and then in our trend following models, our tactical models, to get out of the market when we start to see storms on the horizon, when tornado sirens start to go off, in an attempt to avoid, again, life-changing market crashes. So I have no idea how this year is going to play out, but seasonality-wise, it would be an expectation here between early February and early April to maybe see somewhat of a pullback if the averages don't lie. So we'll just have to see what happens. So in summary, things to pay attention to in 2021. Obviously, 2020 was one of the most strange and difficult years for the stock market in U.S. history. There's no doubt about that. 2021 is still going to feel, I think, the hangover of last year's recession, but between Jerome Powell, Janet Yellen, stimulus, everything at the federal level, that the government's probably going to continue juicing the market up. And I think that it's going to be pretty tough to fight that. Again, market trends are currently pointing northward, but post-election years are historically muted when it compared to the rest of the election cycle, so the other 3 years in the election cycle. And in conclusion, right now, the trend is up until it's not. So as long as we're in an uptrend, as long as the market is healthy, then we want to be invested, and we want to be trying to take risk appropriate with whoever we are as an investor, personality-wise, our investment objectives, our financial plan output. Right now, I wouldn't really be too worried, to be honest. So hopefully you got something out of this today, and if you have any questions, let me know. If you'd like to set up a intro call with us, if you're not a client, we do intro calls for free, 20-minute phone call, answer any questions you have, kind of tell you about our second opinion process. Our second opinion process is just what it says it is, a second opinion, nothing more. We would take you through 3 appointments, discovery, education, and financial plan. And what we want to do is put together a full-blown financial plan, find out if you can get to retirement on time, and then most importantly, how do we conservatively ensure that you never run out of money in retirement, especially for those who are already retired. And then we go over a bunch of other recommendations for things with investment management, tax planning, estate planning, insurance planning, and so on and so forth. And there's no obligation. So if you have interest in that, please reach out to us. You can contact me personally at adam@libertaswealth.com. But if you'd like to set up one of those intro calls, go to our website at libertaswealth.com. On our contact page, you can get access to our calendar there. Otherwise, feel free to follow me on Twitter at Adam Koos, or on Instagram at Financial Surgeon. We're also on Facebook at facebook.com/Libertas Wealth. Otherwise, again, thank you so much for watching today. Hopefully you learned something. I'm wishing you all the best, most successful, prosperous 2021, and I'll look forward to hopefully seeing you all soon.